Hello, everybody. Luke Gromen, FFTT. Hope you are well. Thank you again for joining me for another weekly update. Really enjoy doing these as always. Come in with some applause just to spice it up a bit. Thank you again for submitting the questions. Really appreciate them. Let me jump right in. And the interest of efficiency, quite a bit going on this week. I hope everyone's having fun because what else is there to say about the ups and downs of this week? So, first question is from SB. You've said that the debt-based financial system is inherently unstable. Team Trump says they'll reindustrialize America while keeping the dollar strong and as world reserve currency. Do they see the inherent instability of the system and want to end it, or are they attempting to restructure the system just enough to give the U.S. trade advantages? What's the clearest evidence you see either way? This is a question from SB. I don't know. I can argue a bit of both, and in the end, I'm not sure it matters. Look, you can't restructure a highly leveraged system just a little bit at the end of the day, right? It's not a dial. It's a switch. It's on, it's off. That's what leverage is. A leverage cuts both ways. You can't restructure just a little bit. As we've seen, right? How long did it take for the bond market to get very destabilized after we implemented these tariffs? 3.5, 4 days? Trading days? Not a long time. This is like, I just want to take this one bottom block out of the Jenga tower. Not how it works. One little block, that's all it is. Still collapses a tower. Doesn't matter. So, as a result, I don't have enough conviction what the plan is. There's too many contradictions. And so maintaining the view over the next at least 2 to 3 months, stay low over your skis. I have conviction in T-bills. I have conviction in gold. I don't really have conviction in anything else because I don't really see the game plan here. From Travis, how do you compare the 1992 UK pound short trade that Besant architected to the current tactics being used against China? I think he had a close seat to watching that happen. He was, that's 33 years ago, so he's a pretty young man. But I think thinking that, I've seen this metaphor used by a number of different people. I think it's a bad metaphor. It's like thinking the same football play that you use to win an 8th grade football game, middle school United States football game, or high school American football game will work against the 2024 Super Bowl champion Philadelphia Eagles. Like China and the UK, with all due respect to my friends in the UK, apples and oranges on a number of different ways in this case. Fundamentally, the UK was, it's an island whose industrial base had been largely hollowed out with a big financial system, highly financialized, highly interest rate sensitive as a share of GDP, and that made some of the things that Besant and Soros and Druckenmiller did. You can kind of do the math and you can kind of see the options and the constraints the Bank of England had, and away you go. China is a nation of 1 billion people. They are the world's factory base. They are ingrained into every supply chain of everything in the world, including, by the way, the United States defense base. And that world factory base backs de facto everybody's bonds, sovereign bonds of everybody. So you take China out of the global mix, everybody's sovereign debt market blows up, and then everybody's corporate debt market blows up. So that's why I say it's like, well, it worked against the English. Like, have you heard anyone say recently, hey, well, Milei did it in Argentina, so America can do it, no problem? Those comments have gone away awful fast, haven't they? Same thing. The metaphors, all models are wrong, some are useful. The Milei Argentina model is wrong and unuseful. And in my opinion, the UK Bank of England, Besant breaking the pound with Soros, etc., is also wrong and unuseful as it relates to the China metaphor. And I think importantly as it relates to markets, Wall Street consensus doesn't think that. Which means, look, if I'm wrong, they're going to be right. And if I'm right about this, they're going to be wrong, or we're going to see a lot more action in markets like we've seen over the last week in the future weeks. From Scott, do you think that Miran's 5 tributes to U.S. hegemony speech actually represents the administration's view/demands, or is he still pitching to the president/Navarro to adopt his view of the endgame? I think it's the view of the administration of Trump. And I think it matches with the America First investment policy memo from February that we've talked about in other appearances. The United States wants foreigners to recycle their deficits, American deficits, no longer into U.S. stocks like the Mag 7 and NASDAQ and into U.S. bonds, but instead into U.S. goods, U.S. weapons, cut us a check for tariffs, or put it in gold because that'll help weaken the dollar over time as well. So I think that speech is a very important one that he gave to the Hudson Institute on, what's today, Wednesday? On Monday. I think it's an important one to follow up on. From TMR, to what extent does an increase in manufacturing in the U.S. imply a decrease in exporting dollars? How do we navigate the Triffin paradox in this transition? Critical point. We can export treasuries and financial assets, or we can make stuff. But if we want to make stuff, that's the end of the post-71 U.S. dollar reserve status structure. And it's an underappreciated point. And the way you get around it is you shift the settlement asset away from treasuries to a neutral reserve asset like gold. And I think that process has been started. I thought it was extraordinarily interesting and potentially important that Trump did not put tariffs on gold. He put tariffs on everything else in the world, including an island full of penguins, apparently, but not gold, which tells me that's where we want capital to go. And that'll weaken the dollar, which, guess what? If gold goes up a bunch, you're going to strengthen the dollar system because it'll be more gold backed, and you're going to weaken the dollar. That's how you split the baby around Triffin's dilemma, neutral reserve asset. I think Bitcoin probably benefits over time from that too. From Daryl, explain this week's action in the 10-year. There's a short-term issue. There's a structural issue. Short-term, you have had, as we've talked about ad nauseum, insufficient price-insensitive buying for U.S. Treasuries for 10 years, 10 plus years. Foreign central banks stopped buying in 2014. That's a fact. And so the marginal, you've had to find marginal buyer in private markets. And in recent years, one of the biggest marginal buyers of U.S. Treasuries has been relative value hedge funds who are highly, highly levered in this trade. They are long cash treasuries and they are short futures, and they're basically trying to scalp a few pennies on the trade, and they make it up in volume. So they're only scalping a few pennies on every trade, but you lever it 100x, it's a nice little return. The challenge is that the risk management models of said hedge funds is such that if you have a rise of volatility in really anywhere that gets too high, you degross the entire book of the hedge fund, including degrossing this relative value trade. And so in the short run, that's what's happening. Volatility picked up massively in equities and as a result of the tariffs. And sure, it's when I said Treasury yields are going to start going up when equities go down big, like after a brief drop in 10-year yields, like I wasn't guessing. I knew that was going to happen. It's mechanical. It's going to keep happening because your biggest marginal buyer are relative value hedge funds, one of highly levered, one of the biggest ones at least. And so that is, ultimately a function of not enough demand from price insensitive buyers. Structurally, for the entire first quarter, the United States has spent the time telling the world they do not want U.S. trade deficits recycled into treasuries and other financial assets anymore. And recycle them into gold instead. Recycle them into our goods. Recycle them into investments in factories in the United States. And so the net international investment position of the United States, which was positive 10% of GDP in 1983, it fell to negative 10% in basically a straight line, negative 10% of GDP by roughly 2012, kind of steady erosion. Since 2012 to 2024, it went from negative 10, 12% of GDP to negative 83% of GDP. There's $23 trillion of assets foreigners own here that Trump told they don't want, in particular in the case of Chinese, take your money and go home. So again, there's secularly not a bid for this stuff. The bid relative to what it used to be. There's a declining bid. And so, ultimately, bond selling there. There's insufficient demand relative to our deficits, particularly as it appears deficits are likely increasing with the stock market decline. So, raises a question of who's going to buy the stuff. Ultimately, maybe private sector, but ultimately, I think Fed with printed money. From David, can you provide your thoughts on what Bessent would like the Fed to do in the coming weeks or months? The Fed appears to be obstinate. In your view, does Bessent have a path or a forcing function to get the Fed to align with him? Look, I think the solution to what the problem we have, which is too much debt relative to available balance sheet capacity, is negative real rates. They need the United States, in order to not default on its debt, needs somebody to buy and finance our deficits at rates below the rate of nominal GDP growth. There is no private sector entity in the world that can stay solvent by doing that. And so ultimately, that's going to require probably the Fed or proxies or Treasury acting, maybe via revaluing gold, as we've talked about in the past. But look, nothing happens in Washington without a crisis. So, maybe there's a case it could be made that Bessent is trying to, force a crisis where he creates Treasury market dysfunction to pull the Fed back in. I don't know. But ultimately, there's one solution here. It's negative real rates, very negative real rates for several years. And then the last question, CNH, what are your thoughts on a Yuan devaluation? I just don't think it's likely. I mean, weakness, yes. Devaluation, why? Why would you, if you're China, no devaluation? Look what it did to the bond market in the last 4 days. Why would you do that? Now, critically, if they do devalue, it's going to put more pressure on the bond market paradoxically. So maybe they could, but ultimately, when I say pressure on the bond market, if China doesn't devalue, that's going to put more upward pressure on inflation, more pressure on the bond market, more pressure on corporate margins for the U.S., just in time for the corporations who need to refinance a bolus of debt they took out 5 years ago in COVID at much lower rates. The bond market just showed it doesn't have the wherewithal to take a punch in a trade war, right? We're a week in. Bond market has a glass chin. So, to me, the only case for China devaluing the yuan is if it would probably put severe upward pressure instantaneous on the 10-year Treasury market. But if I'm then, that's going to happen if they just kind of hold tight. So I am of the view at the moment that could change, but at the moment I'm of the view that the Chinese will not significantly devalue the yuan. I think they've got a lot more staying power than consensus thinks. I think they're doing some other things to put pressure on the U.S. and markets, but let's see. So with that, I'm going to sign off for the night. Quick reminder, order of business. This week we are offering a special on tree rings. There's some special upgrades, so check those out at FFTT-LLC.com for more information about those specials for tree rings for this week only. And like I said, if you like these updates, or like I always say, if you like these updates, 10 most interesting things, brief synopsis about what grabbed our attention about them, and how it's either confirming or changing a way we had previously been thinking about the world. So with that, I'm going to sign off. Thank you, as always, for joining me. Thank you for the questions, and hope everybody has a great rest of the week. And hopefully in markets, maybe it'll be a little calmer rest of the week. So take care, everybody.